Chapter 11, Lesson 2, LKAS 2. The objective of this standard is to prescribe the accounting treatment for inventories. So LKAS 2 is dealing with accounting for inventories. This standard applies to all inventories except the exceptional situations. Number 1. Work in progress arising under construction contracts, including directly related service contracts. If you look out from your window, you will be able to see some buildings under construction. Okay, those buildings are inventories from the point of view of the contractor. The person who constructs the building, he is constructing the building for the purpose of selling, like Blue Mountains. Okay, they construct buildings and then sell. So from their point of view, that building is an inventory. So buildings under construction will be exempted from this standard. Then financial instruments. It means treasury bills, treasury bonds, fixed deposits. Third one, biological assets related to agricultural activity and agricultural produce at the point of harvest. Okay, biological assets. If you have visited for a chicken farm, okay, so you will be able to see that there are some livestock. Okay, the next batch to be killed for the purpose of providing meat. So those are inventories from their point of view. So those biological assets are excluded from LKAS 2. Definition: inventories. Now you can see that there are 3 subsections under this definition. When we ask the question define inventories, you will write these 3 sub-features, but in most of the cases you won't write the first sentence. Please remember to write the first sentence. Inventories are assets. That's the first sentence. Then you are going to describe the features. Number 1, held for sale in the ordinary course of business. You have finished the production and you are keeping them for the purpose of reselling. B, in the process of production for such sale. The meaning is you have started the production but you have not finished the production. But your final objective is to resell. So those items are coming under inventories. C, in the form of materials or supplies to be consumed in the production process or in the rendering of services. Okay. The meaning is you haven't started the production, but you bought all items for the purpose of production. So those items are coming under inventories. Okay. Now in chapter 7, manufacturing accounts, you have learned about 3 types of inventories. Can you remember them? What are those 3 types of inventories? Raw materials, work in progress, and finished goods. Okay, now again come to this definition. Inventories are assets. A, held for sale in the ordinary course of business. So what's the type of inventory I am mentioning here? That's finished goods. B, in the process of production for such sale. So what's the type of inventory? It's work in progress. WIP. C, in the form of materials or supplies to be consumed in the production process or process of rendering of services. What's the type of inventory? It's raw material. Net realizable value. Net realizable value is the estimated selling price in the ordinary course of business less the estimated cost of completion and the estimated cost necessary to make the sale. In simple words, NRV, net realizable value, is the net value you are getting from the sale of this inventory. That's an expectation. That's not a real figure. That's an estimated figure. Net realizable value equals estimated selling price minus estimated selling cost. Okay. Now look at this example. Cost of a 17. Okay. The retailer, he has bought this 17 150 rupees each. Now with this COVID-19 situation, the government, they have a control price for a 17. That's, that's 100 rupees. That's the estimated selling price then. Estimated selling cost is 20 rupees per unit. Okay, then look at the formula again. NRV, net realizable value, equals estimated selling price minus estimated selling cost. Estimated selling price is 100, that's minus estimated selling cost is 20. So 100 minus 20, the net realizable value is 80 rupees. Measurement of inventories. Inventories shall be measured at the lower of cost and net realizable value. Remember this rule. Inventories should be measured at the lower of cost or NRV. Look at the same example. Cost of a 17 150, but you have calculated the net realizable value as 80 rupees before. Okay, now according to LKAS 2, inventories should be valued at the lower of cost or NRV. Now cost is 150 and NRV is 80. So lower of cost or NRV, lower of 150 or 80. Okay, so the value is 80 NRV. So inventory has to be recorded as 80 rupees under current assets in the statement of financial position. Is this clear? Lower of cost or NRV, that value will be entered under current assets of statement of financial position. Now look at the next concept. Stock lost. You bought a 17 for 150 rupees. But now your net realizable value is 80. So this retailer is going to make a loss of 70 rupees from a 17. So where do you record this loss? It has to be recorded under other costs of the income statement. Okay, again I am coming to a summary. Inventories has to be measured at the lower of cost or NRV. So that lower value will be recorded under current assets in the statement of financial position. Cost of inventories. The cost of inventories shall comprise all cost of purchase, cost of conversion and other costs incurred in bringing the inventories to their present location and condition. So when it comes to cost of inventories, it has three parts. Cost of purchase, cost of conversion and other costs incurred in bringing the inventories to their present location and condition. Now look at the picture. Now I have taken a fruit juice and jam manufacturing company as an example. Okay, the price which they have paid when they are buying fruits, that's cost of purchase. then they'll be grinding, mixing those fruits. So that's the cost of conversion. Then they are bottling them and further processing, and then they are delivering. So that's the other cost incurred in bringing the inventories to their present location and condition. Okay, so I think the cost of inventories concept will be very clear when you look at this picture. Okay, again I'm coming to a summary. Cost of inventories, it has three parts. One, cost of purchase. Two, cost of conversion. And three, other cost incurred in bringing the inventories to their present location and condition. Disclosures. Okay, the last part of every accounting standard is the disclosure requirements part. That's very important. Number one, the accounting policy is adopted in measuring inventories, including the cost formula used. You have to clearly mention your cost formula which you have used in measuring inventories, whether it's first in first out method or weighted average cost method. B, the total carrying amount of inventories and the carrying amount in classification appropriate to the entity. Okay, if you have a manufacturing business, you have to classify your inventories into raw materials, WIP and finished goods, and then you have to represent the total in your statement of financial position under current assets. C, the amount of inventory is recognized as an expense during the period. Okay, if you have any inventory damages, you have to disclose them. Next one, the amount of any write down of inventories recognized as an expense during the period. What do you mean by that? Any write down of inventories. Now when it comes to salmon price and dal price, now it has been reduced, so it's a write down of inventory, so it has to be disclosed with this special reason. Next one, the amount of any reversal of any write down. For example, suddenly if the salmon price and the dal price has gone up, then you have to disclose the reversal of the write down of that inventory. Last one, the carrying amount of inventory is pledged as securities for liabilities. Sometimes when you obtain loans, those banks or other financial institutions, they might be asking some securities. So, if you have kept your inventories as a security when you obtain the loan, so you have to disclose that very clearly. The reason is you might not be able to sell that inventory until you settle the liability. So, it has to be disclosed. So, when it comes to disclosure requirements, okay, please try to remember at least 4 disclosure requirements per accounting standard.